folks, we're seeing a hammering of speculation stocks like I've never seen before. Look, I've warned about this before. You look throughout really a vast majority of these speculative stocks, you're seeing a lot of bad performances this week, and I think it's because valuations are finally catching up with some of these companies. That's why I've always told you, looking for value plays is always a decent idea. You see companies like Tesla is a fantastic company, yet trading at a PE ratio over 300. Things down over 14% in the last 5 days alone. Really in the last couple days, if we're being honest. So within a 4-day span, the thing has fallen around 15%. So just keep that into consideration. You got companies like NEO. This is not a profitable company. The company does not make profit, trading at a relatively high market cap for what they make in terms of revenue. Down 20% in the last 5 days. Plug Power, another one of these companies that has been really elevated over the last 2 years, I would say is fair. Hello, dog. And it's been getting hammered lately, 18% in the last 5 days. But again, you look at these stocks and you see, well, they've had big bursts over the last year. NEO, if you look 5 years out too, that'd be an even different story here. I mean, you see the big burst. Tesla's in the same exact boat. They've seen such massive jumps in valuation over the last 5 years. I think they're finally getting a pullback because let's be clear, a stock cannot infinitely go up, by high percentages every single day. It just can't. It's got to take a little bit of a pullback period. Peloton, 6% down, down big on the year. And this is one that, if you look really since IPO in 2019, still up quite a bit, but it was pulling back in valuation. Who else? ARK isn't even safe. ARK Innovation ETF down 13%. The ARK Next Generation Internet ETF down 13.6 in the last 5 days. So even these ARK funds, which typically invest in non-profitable companies with higher valuations, they are struggling as well for that very same reason. But let's say you're invested in the indices. I talk about this a lot, why it's good to have a lot of exposure in a very diversified portfolio. And this is why. The NASDAQ, well, it's still down big because tech's been taking a big hit. But it's only down 4.6. Not nearly as bad as the others. The S&P 500 only down 1.2, and the Dow Jones actually up in the last 5 days. So this just goes to show it doesn't necessarily hurt to have a lot of money in general indices. It doesn't hurt because these are a lot more secure investments that are less likely to have dips like you just saw there. Now, does this mean there's not a buying opportunity? I'm not going to say it doesn't, because we'll talk about my investment strategy in just a little bit during these times. Because yes, when I see dips in some of these stocks that are traded at such high valuations before, some of these are absolutely worth buying right now, worth picking up. And then you have companies like Apple, which just say they've been getting absolutely mistreated in terms of what they should be. I mean, when you look a year out, 34% up. I think this stock should be up higher than a lot of the companies that have been trading at way higher percentage growth. I mean, market cap, it's incredible. But still, this company is trading at a PE ratio under 30, and it's a proven company with a fantastic growing growth rate in terms of revenue. Fantastic. And they paid dividend. This is a company that's been doing fantastic stuff, and some of these companies are finally getting a bump in valuation that they didn't quite see before. So that's where you see the difference overall in terms of the success in the indices. I mean, some of these that are holding more of the value plays are seeing a little bit more benefit, and there's a lot of reasons for it. You need to consider that the fact that we have a bad issue with inflation right now. So inflation obviously growing, but some of these companies are obviously doing great things to counteract that. Mostly being, boosted profit via price raises. I mean, that's how inflation helps you there. If they're not necessarily paying more for the products, but they're charging more, it can increase their bottom line. It really can. It also increases the revenue. So there are good things with certain companies, while others are going to get smashed. If you look historically, interest rates play a big role in the market as well. You've seen such great performance over the last couple of years in terms of the market. In fact, we just look at the Dow Jones. If we just look at the Dow Jones over the last year, I mean, 17% growth is fantastic. And really, since interest rates were cut, the market's up 83% in the span of, a year and a half. Pretty significant, if you ask me. Actually, it's closer to a year and 3/4 a year now. So let's just be clear: 1.75 years. Still fantastic for the market to be doing such great numbers. And why is it? It's because of interest rates. In times when interest rates are low, these everything overall in terms of the market will just be performing better. Okay, yields are down. No one's going to be investing in bonds, any of those low risk, extremely low reward plays. No one's going to be doing that. Your money's way better in the market in times of very low interest rates. Now there's fear that there is fear here that we likely will see interest rates raise in the next year, which is absolutely viable. I think it's absolutely the case. And when interest rates go up, more people will be investing in bonds and pulling out of some of these equities, like stocks. They might be pulling out, or they're going to go into some more simple, less speculative plays, and they typically perform worse. A lot of these speculative plays, super high growth, no profit. These positions, they tend to take a little bit of a step back during these periods. So keep that in consideration. So that's why I have an investment strategy laid out in the way I do. So we have 5 categories that I talk about here: growth, steady companies, or rocks. I talk about rocks a lot. Dividend plays, and I'll give you examples of some of these. Dividend plays, looking for yields over 4%, ETFs, and spec plays. So in my growth positions, I really want around 25 to 30% of my portfolio to be in the growth plays, okay? This is because I don't want to overexert myself and overstep my bounds in case something were to happen in the market quite like this. So if you are in the market and you're playing hyper growth plays, and you have 100% of your portfolio in these positions, right now you're hurting big time. You're hurting big time. You're going to be following closer to where the Nasdaq's at, down 5%. But then when you mix in stuff like this, 15 to 20% of steady companies are rocks. So these are going to be companies that are just very generic. Clorox, Coca-Cola, basic consumer staple stocks, a lot of them. Texas Instruments. Look, these are companies that the share price doesn't move all that much. They might pay a small dividend, around 1%, but the share price doesn't move. Even in the worst times, it's not going to move nearly as much as you are with some of your higher volatility plays. That's why it's good to have these rocks in there to kind of level out that issue. In case the market were to go down, you're leveling out in terms of your loss there. Dividend plays, I love having them because even in times in which the market is down, you're still securing a decent percentage gain. If you're looking for yields over 4%, even if the market went down 10% in a year, but these companies are still paying dividends, you know what? You went ahead and you've absolutely gained money. If you haven't sold anything, you've gained 4% on the year. Even though your portfolio shows down 10%, you've gained 4% on the year because of the fact that you're yielding that way. And technically it's going to be more seeing as share price is down, but that's okay. Yield on cost, at least. We'll go with that. So that's why I like to have some decent dividend plays, typically in companies that you don't expect to cut in times in which the market may be down, or interesting other times in the market, whether it be recession. You want some companies that are a little bit more recession proof in terms of that, but keep that in mind. Then 15 to 20% I love in ETFs. Why? Because you get a nice big wide range of companies, right? When you're looking at ETFs, you're very diversified, and you're looking a lot safer. I love having ETFs, whether it just be SPY, just tracking the S&P 500 completely. If you wanted to do that, that's fine. QQQ, anything of the sort, you can do those. You can absolutely have those. Or you can get into some different ETFs. Some can be more speculative ETFs, like the ARK funds if you wanted to, but I typically go with safer plays with ETFs. So dividend ETFs, just overall Growth ETFs are plenty fine, and overall they level off your loss, and that's great. Again, if the market's down, you're leveling off your loss with these ETFs, so you're not necessarily having all eggs in one basket here. You can't do that. And then I have spec plays in here as less than or equal to 5%. Look, I can't do the actual symbol for less than or equal to that I know of on this little sketchpad thing. That's okay. And why is that? Well, again, it's exactly what I mentioned. These are the plays that get hit the hardest in bad market conditions or bad economic conditions as well. These ones get hammered. You get NEO where you're down 20%. So let's say you have 50% of your wealth in NEO right now. In the last year, you're not doing well. Look, you're probably going to give up on the market if you've had your money in NEO over the last year. Down 40%. You've lost 40% of your money in the last year. If you had 50%, of your wealth in NEO, technically 20%. I guess it depends on what else you did, but you're down 40% on a position that might be 50% of your wealth. I mean, you hate to see that. You hate to see that. So that's why you want to keep this to around 5%. And it's definitely good to have multiple spec plays as well. You don't want to just stick to one company, whether it be NEO. There's other companies out there, Plug Power, any of these companies that aren't necessarily proven but have a high, lofty expectations for the future. Then maybe we can talk about that. But that's why I always say, as you see on the bottom here, you need to have money on the sideline. You don't want all of your wealth in the market. My general guideline is around 30% of your wealth sitting on the sideline. Now, really a lot of financial advisors might disagree with that and have it closer to 10%. But I don't necessarily have that. Don't mind me. It's the first Monday of the month. Don't mind the tornado siren. So we're gonna wrap this thing up because there's not a real tornado, just the sirens. That was very loud to begin with, but now it's not at all. Don't know what that was about. So we're still gonna wrap it up. So you need that money on the sideline, so that way, in times like this, if you have a spec play you really like, you can invest more into it now. If you have growth companies you really like and they're down right now, you can invest more. Dividend plays, you can invest more. If your dividend stocks you're very sure of are down right now, you can invest more into that with that extra percentage of your wealth, and that not only increases your yield on cost when the stock goes up, but you're just having a great time because you're earning more dividends. That's what I got for you. Screw this tornado siren.